Okay, we are on page A, on page 2, part A, page 2. So we're looking at all non-strategic equity investments. So remember, that's shares, not any debt, like bonds. So there is a cost method, but IFRS says no, you have to use the fair value method. Now, under SB, however, non-strategic equity investments, which are active markets, so they're actively traded, should be measured at fair value, and any changes should be in net income. So really, technically, they should fair value through profit and loss or fair value through net income. But if the investment is not listed on an active stock market, or if an irrevocable election is made, the investment can be at cost less impairment. And it's measured at acquisition at cost plus any transaction cost for the purchase. At each reporting date, the investment will stay at cost. Then when realized gains and losses are net income. Okay? So that's IFRS only. Now, fair value through profit and loss, or fair value through net income. So, fair value through profit and loss model, so fair value through profit and loss, fair value net income, applies to investments in equity. Again, we're focusing on equity in this instance. Held for short-term trading and intended to be sold within 1 year, and they're classified as current. Under ASPE, this method would be used for all equity investments that are in an active market. Now, under this model, investments are measured at fair value at acquisition, with any transaction costs being expensed. So, for example, debit broker expense, credit cash. At each reporting date, the asset is measured at fair value. So we mark it to fair value every year, with any unrealized gains or losses being reported in net income. Dividends are recognized in net income as well. Now, the fair value through OCI method, and again, it's fair value through OCI or just FVOCI, is only valid under IFRS and is used for investments in equity instruments which are not held for short-term trading and for which management has irrevocably elected as fair value through OCI. Okay, so they can't change their mind. At acquisition, so when we buy them, the equity are measured at fair value, again, what the value is on that day, including any transaction costs. Now, the transaction costs are not expensed like number 2, but are capitalized. So if we had broker fees for shares, we would actually debit the common shares, not an expense. And we'd credit cash. So at each reporting date, for sure every year, possibly every quarter, the asset should be measured at fair value. Any unrealized gains and losses are recognized in OCI. So remember, it's below net income. At sale, realized gains and losses are transferred directly into retained earnings without recycling. Earlier on with IFRS, you could recycle it or not. Now they've moved to not recycling. Therefore, the gains and losses, the actual gains and losses from sale, are never recognized in net income. They have to stay in OCI and will not influence EPS. Okay, it becomes very hard to compare different companies' EPS when one's following different rules. So that's why. Okay, so let's do an example of some of these and try to get it straight in our head, which are which. Again, you have done all of these in 315. So, example 1, prepare the following entries on the next page because I left you space to do it so that you can compare all of them. So get page 4 out. Okay. So here's the transactions. January 1st, Genstar purchases 10% of the outstanding common shares of SafeBuy for $95,000 cash. Now, right from reading this, do we have significant influence? Do we have control? What do we have? Well, look at your last page. And 20 is non-strategic. So this is non-strategic. What are our choices for ASPE? Well, we can either use cost or fair value through net income. And for IFRS, when it's non-strategic, you can either use fair value through net income or fair value through OCI. Okay, so that's what we're dealing with. Now, at the end of the year, it tells you what the fair value talks about, how they reported net income, paid dividends, and so on. And then January 10th, year 2, they sold its interest in SafeBuy for $99,000. Okay, so let's go through page 4. And keep page 3 handy so you kind of can pay attention to it. So let's do the same little chart here. This could be ASPE, and this could be ASPE. And this is IFRS or IFRS. So let's do cash. What happens on January 1st? We purchase the investment. So we make a purchase. So we record an investment, we credit cash, and all three kinds would look exactly. Now, near the end of the year, we get a dividend from SafeBuy. So this is the dividend. We get cash. Notice we don't get $80,000. How come? We only own 10%. We only own 10%. And again, the entries are all the same. Okay, so they're nice and straightforward. However, now we get to marking fair value. It's the end of the year and we have to mark to fair value. Now, do we have to fair value? Is that what we do there? No, cost never gets marked to fair value unless it's impaired. So, what happened to our investment? Well, if we have our little investment account, whether it's fair value through profit and loss or VI, well, what did we buy our investment for? Well, $95,000. Has it changed in value? Yep, they said the value was $98,000. So it's increased to $98,000. which means it's done what? Gone up by 3,000. So we have to record that. Now we know we don't for cost, but has the investment gone up or down? Do we debit or credit it? Well, we've got to make it go up, so we're going to investment, and it went up by 3,000. Now there's a difference. What we credit under IFRS for fair value through profit or loss, what do we credit to? Unrealized gain, and remember through net income. So we'll put it here. So at the end, we have to close to retained earnings if we're closing it. Now, if we're doing OCI, we don't put unrealized gain in net income. We put unrealized gain in OCI. So you actually have to put that on your account. Oops, what am I doing? Okay, does that make sense? So there's nothing, we're not using that line. Everybody good? Okay. Now this unrealized gain to OCI gets closed to AOCI. So we're going to actually do that right now, even though you don't have to do it until the end of a year, depending on the circumstances. You can close it when you sell. So we're going to close to AOCI. So we're going to debit unrealized gains OCI and credit accumulated OCI, which is like retained earnings. Okay, so just to quickly recap, cost is easy. You don't do anything unless it was in fair value through profit and loss. You record it. You record its dividend just like the other two, but then end of the year or end of the quarter, whenever you're doing financial statements, you record an unrealized gain to them and the investment going up. Now with OCI, again, the first two are identical. It's this third one, when you mark to fair value, you can't use the net income account, you have to use an OCI account. But essentially you're doing the exact same thing. It's just where this 3,000 goes, go into net income or OCI. Then, and I'm just showing you this so you know what happens and you keep remembering. OCI stuff gets closed into accumulated OCI or AOCI. So you have to make it sure it goes in there. Okay, on January 10th, we sold the investment. So, how do I want to do this? So, the sale of investment. So, in our little January 10th entry on the other page, it says Genstar sold its interest for $99,000. So our $99,000 is not going to change. We sold it for $99,000, got some cash. Now we have to close the investment in SafeBuy. So let's look at cost first. And what was cost of the investment under the cost method? Well, we put it in at 95, and did we change it for fair value? No. So it's still 95. Well, there's a difference of 4,000. That must be a gain on sale. Okay? So that's cost. Now let's do fair value through profit and loss. What's the balance in this fair value account before we get here? Well, it was 95, but now it's 98 because we added that 3,000 in. So we have to close this investment account for 98. And that's from there. So, do we have a gain or a loss? Well, we're short credit, so it must be a gain. So we fill in 1,000. That's just fill in the blank, just like this was. Okay, and notice it's in net income. Everybody good? Okay, now let's try our fair value through OCI. So what was the balance in the investment under OCI? It was 8, because remember we both wrote both methods up by 3,000. So this is going to be 98,000. Remember we said we never let things go to income? Then that extra $1,000 of a gain, that's between these two numbers, is going to go into gain on sale OCI. So remember, this has to be OCI because we're keeping all the OCI stuff together. So just so you see how we can close OCI and AOCI, I'll just show you right here. So we want to close OCI and AOCI. So we need to close this gain on sale OCI. Where do we close it to? Well, we debit it.